The Fed said they're not going to cause a recession. The yield curve says they're going to be wrong. Who's right? I'm your host, Steven Van Metre, and thanks for joining me today. And one of the best indicators of a recession is now inverting, and the Fed says this time it's wrong. Let's dig a little deeper and see who's right. And Bloomberg kicks his story off with this headline: recession warning sign. Part of the U.S. yield curve inverts for the first time since 2006. Treasury slumped a new ascend, a widely watched part of the U.S. yield curve, to its first inversion in 16 years. The curve is flattening as investors bet on the Federal Reserve will tighten policy rapidly enough to sustain a slowdown in growth. And here you can see the chart from Bloomberg, and we're going to look at this even deeper so you understand have a better understanding what is going on here. But when the curve falls below this line, this zero bound, it is an indicator that a recession is coming. And the last time this happened, well, we had something called the Great Financial Crisis. Let's continue on, because Powell also pushed back against concern that an inverted yield curve would signal the economy is headed for a recession, saying it made more sense to focus on the shorter end where curves remain steep. And what he's referring to is the front end of the Treasury curve, the 1 month, 3 month notes, 2 year. That's what he's looking at, is the bills and those short-term note yields, and saying no cause for alarm here. We know what we're doing. But do they? And let's dig deeper, because explainer, yield curve flattening inversion, what is this telling us? The shape of the yield curve is a key metric investors watch as it impacts other asset prices, feeds through bank returns, which I've talked about, and has been an indicator of how the economy will fare. Now, why does this matter to banks? Because banks lend at the short end of the curve where rates are really low, and they lend it out they borrow at the short end, they lend out at the long end. So the price that you're paying for interest is not the same price they are, and they make money on the spread. So when that all gets sandwiched together and there's not much gap between the front end and the long end, well, the bank's ability to make a profit goes away. And in fact, what they start to do is tighten lending standards because they cannot afford default risk. And that's one of the big keys here that I think the Fed is missing. Recent moves have reflected investor worries over whether the Fed can tighten monetary policy to tame inflation without hurting economic growth. Well, good luck with that. The U.S. Treasury finances federal government budget obligations by issuing various forms of debt. The $23 trillion Treasury market includes bills with maturities from 1 month to 1 year, notes from 2 years to 10 years, as well as 20 and 30-year bonds. Typically, the curve slopes upward because investors expect more compensation for taking on the risk that rising inflation will lower the expected return from owning longer dated bonds. And that means a 10-year note typically yields more than a 2-year note because it has a longer duration. And this makes sense. When we look at yields, what we should see, and this is we should see 30-year yields are higher than 20, 20 are higher than 10, 10 are higher than 7, 5, 3, 2, 1, and so forth down. That's what you should see as a normal distribution, because the yields are pricing in risk. And so the more risk you're willing to take over a longer period of time, you should get compensated for that. But when it starts to go the other direction, where long yields are falling below intermediate and short-term yields, it's a big, big warning sign. Let's continue on, because a steepening curve usually signals expectations of stronger economic growth. And what they're referring to here is as the curve rises. So if you have a properly constructed curve where long-term yields are higher than short-term, what you want to see is them all moving higher together. And that's telling you that growth expectations are exceeding inflation expectations. That's exactly what you want to see under normal conditions. A flattening curve, which is what we're seeing now, meaning the opposite. Investors expect rate hikes in the near term. Yes, we do. Fed has said that, and have lost confidence in the economy's growth outlook. And so that's exactly what we're seeing today. And this call comes back to this inflation story, because what is the Fed trying to do right now is they're trying to hike rates to curb inflation. But is the yield curve telling them that that's not actually what's going to happen and that the Fed is going to over tighten? Well, let's take a look at this chart, because what I've got is the 530s curve, which is a 30-year yield minus the 5-year yield. And then I overlaid the consumer price index on a year-over-year rate change in red. And what I want to show you is that when the curves are inverted, so you see down here in 1980, you'll notice there was a peak in the CPI. And here you can see coming into the late 80s, the curve inverted, and then inflation shortly thereafter here in red peaked. How about we go into the dot-com bubble? Curve inverted, inflation plateaued, and then peaked. Here you could see again with the curve almost just barely inverted ahead of the great financial crisis. There was a brief peak in inflation. Crude oil took it higher and then came crashing down as the curve rose. And then look back here to the pandemic. We can see two instances. One, we can see here where the curve didn't get inverted, but came very low, and the Fed started to ease back here in 2018. And what happened? That drove the curve higher and inflation down. So we see the same dynamic. But now look at the opposite. We see where the curve up here is high and inflation is low. And so you can see they're not mirrors of each other. But what this is suggesting is that inflation is soon to peak. And of course, if you've been following the Fed and watching the show, we know that the Fed has talked about plans to hike aggressively not only this year, but into early next year. And what the yield curve is telling them, you're making the wrong move. Well, let's keep going so you understand more of how this works. The U.S. curve is inverted before each recession since 1955. Now, that's pretty good odds, with the recession falling between 6 to 24 months, according to a 2018 report by researchers at the Federal Reserve Bank of San Francisco. So it offered a false signal just once. So here we have the Fed saying, there's nothing to see here. There's nothing at all. There's no chance of recession. But their own data says that we are within 6 to 24 months of recession. And there's only been one false positive, and that's not very good for the Fed, because maybe they're betting on a second one. Well, I'll take the odds against that. Yields of the short-term U.S. government debt have been rising quickly this year, reflecting expectations of a series of rate hikes by the U.S. Federal Reserve, while longer-dated government bond yields have moved at a slower pace amid concerns policy tightening may hurt the economy. And that's exactly what you start to see when you hear that term flattening, where the long-term rates are coming down, short-term rates are coming up, and it's flattening out. And we're now starting to see in some parts of the curve where it's inverting, where long-term yields are actually below intermediate term. And that is, again, the warning sign, that inversion that we're looking at. So researchers at the Fed, meanwhile, put out a paper on March 25th, just a few days ago, suggesting the predicted power of the spreads between 2- and 10-year treasuries to signal a coming recession is probably spurious, and suggested better herald of a coming economic slowdown is a spread of treasuries with maturity of less than 2 years. Now, we've looked at the 2-10s yield curve before, and I'm not going to show you it now. We're going to look at a bigger chart of that in a moment. But again, the Fed has got this wrong. The 2-10s is called a recession every time. But what I want to look at now is a chart showing everything that is inverted or almost inverted, so you can see just how wrong the Fed is. And what happens now, you see these inversions in this gray line, and I've got them all stacked together. You've got the 5s30, the 7-10s, the 5-10s, and the 3-10s. So that means 3-year yields are higher than 10, 5 higher than 10, 7 higher than 10, and 5 higher than 30. And notice every time you see this, a recession is soon to fall. Here you have inversion, recession, inversion, recession, inversion, recession. You get it. So now we're seeing them flatten out and head into an inversion, and that means recession's coming. But I'll tell you one thing, a recession doesn't have to come for, and that's your portfolio. Be sure to check out Portfolio Shield. I'll put a link up here in the corner and the description below. You'll be glad you did. But let's continue on with the story, because some people say, this recession indicator, this yield curve thing, it's old news, doesn't matter anymore. Here from this headline from Bloomberg, that the reliable recession indicator may be sending a false alarm as the yield curve is close to inverting, but not for the usual reasons. Right, and just so we're clear, the usual reasons is that growth and inflation expectations are going to start to fall. And what the long end of the curve is saying is they are. The short end is saying there's still short-term inflationary pressures that could persist for months longer, and the long end of the curve is saying inflation is coming down. And that's why I showed you that chart earlier against the CPI, because it's telling us, the long end of the curve is telling us this inflation story is going to go away. And if it doesn't go away, growth is going to come down so much that it will force the inflation story down. But some people don't believe in that. In normal times, the yield curve runs uphill. That is, treasuries with longer maturities, as we talked about, offer higher yields than shorter dated ones to compensate investors for the risk of tying up their money for longer periods. When longer term yields sink close to, as they are right now, or below shorter term ones, as we're seeing now, it is a sign that investors are pessimistic about economic growth prospects. Bingo, that's it, and often portends a recession. Exactly. So what's the problem? Now, to fight inflation, the Fed has started raising the federal funds rate. The price of the federal funds futures indicate that investors expect the central bank to raise rates 8 times by a total of 2 percentage points by year end, kind of as I mentioned before. Accordingly, yields on shorter term notes have been climbing quickly, and all they're doing is anticipating what the Fed's doing. doing. So the shorter term rates are rising in anticipation the Fed's going to hike. But what's the story on the other end of this is, meanwhile, yields on longer term treasuries remain suppressed by the Fed's quantitative easing, which is odd because that ended. Until early March, the central bank was still buying longer dated treasuries, and they have stopped, helping to keep their prices high and yields low. The round of QE that began in March 2020 in response to the pandemic may have distorted the 30-year bond yield by about 50 basis points, according to Morgan Stanley. So the yield curve may invert, not in response to economic conditions, but as a reflection of Fed policy. Well, here's news for them. In 2018, the Fed actually had done 3 rounds of quantitative easing and a little bit of quantitative tightening, and then they stopped and eased again in 2018, and the curve almost inverted. So I don't know that I agree with this much at all, but the financial community may learn to live with an inverted curve. Well, I don't think they will. That's not a signal of impending doom, but it is. And still a pity that the Fed policy has broken the most reliable barometer of recession risk. But I'll take those odds any day of the week, because the yield curve is telling us that growth expectations are coming down. That's what the longest is telling us. The front end saying they're going to be persistent, and the Fed is going to tighten. And that's the part I want you to understand, is what the Fed's going to do is, as inflation comes down, the Fed's going to tighten. Because what they normally do when inflation comes down, they ease, but they're saying, no, not this time. Fed triggers recession, so we'll go with Fed's got this wrong, yield curve's got it right, but stay tuned. We'll keep track of this in future shows. We'll see who's right or wrong. Again, I'm Steven Van Metre. Thanks for watching. Thanks for being fans. Bye now.